So are we looking at basically the steal of the decade here, or is this just a classic value trap waiting to completely crush retail traders?
I mean, that is the billion-dollar question right now.
Right, because the disconnect on Snowflake stock ticker SNOW is just staggering today.
Yeah, it really is.
Like today is April 14th, 2026. The stock is sitting at $134.24.
And it just staged, what, a massive 11.14% recovery rally?
Exactly. A violent rally right after hitting a terrifying 52-week low just 4 days ago on April 10th.
Right, so you have these institutional algorithms stepping in to buy the dip.
But at the exact same time, corporate insiders are just unloading shares at a terrifying pace.
It's a textbook market paradox, you know? The tape is telling you one story like extreme technical damage and panic selling.
Yeah.
But then the underlying cash flow metrics suggest the core engine is actually humming along fine.
Which is wild.
Right. So the real question for this deep dive is whether the market is just mispricing their massive pivot into AI or
if the street is finally waking up to the realities of SaaS valuation compression.
Exactly.
Which makes this the perfect subject to tear apart today. We are going to dissect Snowflake's fiscal 2026 financials, strip down the mechanics of this brutal technical downtrend.
And really decode whether this insider exodus makes SNOW a toxic asset or, an undervalued AI powerhouse.
Right. But before we rip into the balance sheet, a quick reminder to everyone listening. You need to hit the like button, subscribe to the YouTube channel, and most importantly, it is compulsory. Leave a comment with your take.
Yeah, we want to hear from you.
The debate doesn't end here, right? We want your feedback in the comments.
And as always, just to set the ground rules here, this deep dive is a natural human debate and analysis of the data.
Purely educational.
Right, educational and entertainment purposes only. None of this is financial advice.
Definitely not financial advice. So, okay, let's unpack this. I want to start with the raw numbers because the fiscal year 2026 income statement presents this massive contradiction.
Oh, it really does.
Right. Total revenue is $4.68 billion.
Which is up 29% year over year.
Exactly, up 29%. In this macro environment, almost 30% top-line growth at that massive scale is phenomenal.
It's huge.
But then you drop down to the bottom line, and the net loss is a staggering negative $1.33 billion.
Yeah, that's tough to look at.
I mean, that's a net profit margin of negative 28.43%. My immediate reaction looking at that is this just the classic high-growth, high-burn software trap?
Right, like they're scaling revenue but just incinerating capital to do it.
Exactly.
Well, what's fascinating here is that the GAAP accounting definitely paints a grim picture. I mean, when you factor in generally accepted accounting principles, a $1.33 billion loss is hard to stomach.
Oh, absolutely. And if you pull up the balance sheet, you see total assets at $9.13 billion against liabilities of $7.21 billion.
But the metric that is really spooking the market right now is total equity.
Yeah, that drop was insane.
It dropped from $3.01 billion in 2025 down to $1.92 billion today. I mean, that's a third of their equity just wiped out in 12 months.
I mean, look, I understand they are pivoting, right? They're going from being just a cloud data warehouse to a full-blown AI infrastructure company.
The AI pivot.
But burning over $1 billion in equity to build out server architecture and compute power, that is incredibly capital intensive. At what point does the cash runway become a serious issue?
Well, that's where we really have to separate the accounting reality from the cash reality.
Okay, what do you mean?
So if you look at the cash flow statement, the narrative completely flips.
Really?
Yeah. Despite those massive GAAP net losses, their cash from operations is actually a positive $1.22 billion.
Great, wow.
And their levered free cash flow, the actual cash left over after paying all financial obligations is $1.59 billion.
Okay, I want to pause on that for a second because the gap between a $1.33 billion GAAP loss and a positive $1.59 billion in free cash flow is enormous.
It's a massive delta, yeah.
So for the listeners tracking the mechanics here, that delta is almost entirely driven by two massive non-cash expenses, right?
Right.
The depreciation of all those new AI data centers and stock-based compensation.
You nailed it. Yeah. And this is where analyzing SaaS companies gets highly nuanced.
Right.
Snowflake is laying out billions for heavy iron, the actual physical compute infrastructure required for AI.
The actual hardware.
Exactly. And in GAAP accounting, you depreciate those assets over time, which drags down your net income on paper, even though the cash has already been spent.
Makes sense.
But the other side of that coin is the stock-based comp.
Which is the real catch-22 for retail investors here.
Oh, 100%.
Because, sure, paying your engineers in stock instead of cash keeps your levered free cash flow at that super healthy $1.59 billion level.
Right. It acts as a safety net.
It ensures survival. It funds the AI build-out without taking on, massive debt. But for the actual shareholder, you are paying for that survival through dilution.
Yeah, your slice of the pie just gets smaller every single quarter they issue new shares to employees.
It's a huge cost.
It is the exact trade-off. The core business is internally efficient, and it has the safety net it needs to navigate this crazy capital-intensive phase.
Right.
But the market is heavily discounting the stock because of that exact dilution and the sheer cost of this pivot.
And I think that perfectly bridges us to the technical damage. Here's where it gets really interesting, because if the underlying cash engine is producing, the punishment on the open market seems so severe.
It really is brutal.
Let's look at the chart. Snowflake's 52-week high was $280.67. Today, we are looking at $134.
Yeah.
That is a 52% haircut. I mean, for someone casually logging into their brokerage account, it looks like a 50% off sale, but the trend lines look awful.
They are objectively terrible. The moving averages confirm a sustained aggressive distribution phase by large institutions.
Right. I mean, right now, we are trading well below the 50-day simple moving average, which is sitting at 167.05.
Which confirms the short-term momentum is entirely broken.
Completely broken. But then when you look at the 200-day SMA, it's sitting way up at 212.33.
Wow.
And the 200-day is generally viewed as the institutional cost basis over the last year, right?
Exactly. So being $80 below that line means a massive block of institutional holders are deeply, deeply underwater right now.
And that creates a highly toxic technical environment for the stock.
Oh, absolutely. Because every time the stock tries to rally, those underwater funds just sell into the strength.
Just to break even.
Right. Or to minimize their losses. It creates this heavy ceiling of supply. But we also have to look at what happened on April 10th.
The low.
Yeah, the selling leading up to that $121 low was relentless.
The indicators were flashing red across the board.
Yeah.
I mean, the relative strength index, the RSI, alongside the MCD, essentially flatlined into extreme oversold territory.
Yeah, let's look at the mechanics of those indicators for a second.
Right.
The RSI isn't a magic 8-ball, right?
Right, of course.
It measures the velocity and magnitude of recent price changes. When a stock drops that far, that fast, it stretches beyond standard deviations.
Like a rubber band.
Exactly. At $118 to $121, the mathematical probability of a mean reversion bounce becomes incredibly high.
So algorithmic trading systems are programmed to trigger buy orders when the rubber band is stretched that far to the downside.
Which perfectly explains the violent 11.14% rally over the last 4 days.
But here's the critical distinction we need to make for you listening. Is this a structural reversal, or is it just a mechanical short-covering rally?
A dead cat bounce, basically.
Right, because if it's just the algos covering short positions and buying an oversold dip, this is going to fail and resume the downtrend.
Well, we have to look at the volume profile at that $120 psychological support level.
Okay, what does it show?
There was really heavy buy-side volume defending that line in the sand. Institutional buyers clearly decided the valuation at 120 was just too cheap to ignore.
Probably anchoring to that $1.59 billion in free cash flow.
Exactly. However, we have a major resistance node sitting right at $150.
The 150 mark.
Right. If this 11% rally is just short covering, it's going to hit 150 and act like a brick wall. The stock needs to break 150 on massive volume to confirm any real trend change.
Well, the institutional defense of the 120 level is fascinating, especially when you contrast it with what the corporate insiders are actually doing.
Oh, man, the insider selling.
Over the last 90 days, Snowflake insiders have dumped $108.8 million in stock.
That is a staggering number.
Right. I know we often dismiss insider selling as routine tax harvesting or Schedule 10b5-1 plans, but over $100 million in 3 months.
During a 52% drawdown, no less?
Exactly. That is a massive red flag.
Yes.
If Snowflake is the toll booth for the AI revolution, meaning every company has to pay them to integrate clean AI data, why are their own executives selling off?
Yeah, are retail traders stepping into a massive value trap here?
That's the question.
It's one of the strongest bearish signals on the board right now. When the executives, who literally have the highest visibility into the upcoming quarter's enterprise spending, are accelerating their stock sales at 52-week lows, it just shatters retail
It
confidence.
feeds directly into the bear thesis.
Right, that this stock is a toxic value trap.
So let's lay out that bear case properly. The bears are looking at this from a valuation perspective. Even down 52%, analysts are still keeping sell or hold ratings.
Yeah, because on a price-to-sales basis, Snowflake is still historically expensive compared to peers.
Like Databricks or just cheaper cloud storage from AWS or Azure. But wait, why are we focusing on price to sales here instead of the traditional price to earnings ratio?
Oh, well, because the jack net losses we discussed earlier basically render the PE ratio completely useless.
Ah, right, negative earnings.
Yeah. When earnings are technically negative due to the AI build-out and stock-based comp, analysts have to fall back to a multiple of top-line revenue, the price to sales.
Makes sense.
And bears argue that paying a premium multiple for revenue growth is super dangerous right now because of the syspocalypse.
Ah, the dreaded syspocalypse, enterprise software spending fatigue.
Exactly. During the 2020 to 2022 run-up, CFOs were basically writing blank checks for every SaaS tool on the market.
Just buying everything.
Right. But now, with the cost of capital elevated, those same CFOs are consolidating IT budgets. They are ruthlessly cutting software redundancies.
And Snowflake's consumption-based pricing model, where companies pay more as they use more compute power, makes it a prime target for budget cuts, right?
Yeah, exactly. When corporations try to rein in their data costs, consumption models get hit first.
And retail traders get absolutely decimated in these scenarios. They fall victim to anchoring.
Oh, the anchoring is huge.
They see that $280 peak, they see on 34 today, and they assume it's a bargain. They don't realize the macroeconomic environment that supported a 280 valuation simply no longer exists.
Yeah, but we cannot ignore the counter-argument here because the bull case is deeply rooted in the architecture of the AI revolution itself.
Right.
The bears see Snowflake as an expensive luxury in a tight budget environment, but the bulls, they see it as the central nervous system for corporate AI.
I love that analogy, actually, because it moves past the idea of Snowflake just being a static vault for data.
Exactly.
The core logic of the bull thesis is that large language models, no matter how sophisticated they get, are completely useless to a corporation if they are trained on siloed, messy data.
Garbage in, garbage out.
Right. You can't just plug an AI into a chaotic network of legacy spreadsheets. Snowflake acts as a translation layer. It centralizes and standardizes all the data so the AI can actually parse it.
And that is their massive moat. Migrating an entire enterprise's data infrastructure off Snowflake to a cheaper competitor is, well, it's an operational nightmare.
It would take years.
Right. And we actually have the metric to prove that customers aren't leaving. Their net revenue retention, or NRR, is sitting at 125%.
That metric is wild.
It really is.
For context, for you listening, an NRR of 125% means that even if Snowflake fired its entire sales team tomorrow and didn't sign a single new client, their revenue from existing clients would still grow by 25% this year.
It's incredible. It means companies aren't just stuck on the platform. Their consumption of the data compute is actively increasing.
So when you put that 125% retention rate up against the 108.8 million in insider selling, you really see the tension.
Yeah, it's a total tug of war.
The insider selling signals severe short-term headwinds, perhaps expecting a slowdown in consumption growth next quarter. But that retention rate signals massive long-term structural stickiness.
It's a tug of war between the tape and the product, and retail investors often get crushed in the middle of these institutional battles.
So what does this all mean for the listener tracking this stock? Let's look at the actual timeline and the scenarios playing out here.
Okay, let's map it out.
In the short-term best-case scenario, this 11% bounce actually has momentum. The institutional buy-side volume holds the $120 floor, and the stock grinds up to test that major resistance zone between 140 and 150.
Right.
And if it reclaims the 150, the moving averages begin to flatten out, and the narrative shifts from falling knife to an accumulation phase.
Conversely, the worst-case short-term scenario is that the 120 support cracks.
Right, if that floor gives out.
Yeah, if broader market volatility hits or if enterprise software spending data comes in weaker than expected, those algorithmic buyers will just vanish.
And if 120 breaks, there's very little historical volume support beneath it.
Almost none, meaning the stock enters price discovery to the downside. It could get really ugly.
But stepping back from the immediate price action, What actually determines Snowflake's long-term survival? How do they justify the billions they are burning in equity to escape this apocalypse?
Well, this raises an important question because it entirely hinges on their pivot from a traditional data warehouse to an AI operating system.
The AIOS.
Yeah. The traditional data storage market is rapidly commoditizing. Storage is just getting cheaper everywhere.
AWS, Azure, Google.
Exactly. Snowflake knows they can't command a premium valuation just for holding data anymore. Their future relies on new products like Cortex and Snowflake Intelligence.
Let's break down Cortex for a second, because I
Yeah.
think a lot of people misunderstand what it actually does.
Yeah.
Traditionally, if a company wanted to run heavy AI models, they had to take their data out of their storage system and move it to a completely separate compute environment.
Which incurs massive egress fees and huge security risks.
Exactly. But Cortex flips that architecture.
Yeah.
It brings the AI compute directly to where the data already lives inside Snowflake.
Right. They are building a platform where developers can create and deploy AI applications natively.
So if they successfully transition from being the facility where you passively store data into the active operating system where you execute AI,
Then the equity they are burning today to build those data centers is the most brilliant capital allocation possible.
it's an all-or-nothing structural bet on the future of enterprise compute.
It really is.
Let's pull all of these threads together as we wrap up. On one side of the ledger, we have a brutally damaged 52-week technical chart. Heavy institutional overhead resistance at $150, $108.8 million in recent executive insider selling, and the macro threat of the apocalypse shrinking IT budgets.
Yep. But on the other side, you have a business generating $1.59 billion in levered free cash flow, an incredibly sticky product with 125% net revenue retention, and the foundational architecture to become the translation layer for corporate AI applications.
It really is a binary setup. We are either witnessing the capitulation low of a future trillion-dollar infrastructure giant or the early stages of a massive multiple compression for an overpriced software stock.
Well, I will leave you with this final thought to mull over. If clean, centralized enterprise data is truly the new oil for the AI revolution, Snowflake has undoubtedly built the ultimate vault for it.
Absolutely.
But as they bleed equity to build out their AI infrastructure, the multi-billion-dollar question remains. Will their new tools like Cortex be enough to keep them ahead of cheaper competitors? Or is that $150 resistance ceiling going to act as a brick wall for this recovery?
I think that is the perfect framing to end on. If you've been tracking SNOW, or if you're just studying the mechanics of how the market reprices these massive sauce pivots, hit that like button, subscribe to the channel, and jump into the comments right now to answer that cliffhanger.
Yeah, let us know.
Do you see the $120 floor as the ultimate buying opportunity? Or is this just a mechanical bounce in a doomed value trap? Let us know your thesis. Thanks for joining us on this deep dive, and we'll catch you next time.